All right, we're so excited to have you. This is great. This is Nolan Sanburn and Mackinley Baird here. We are excited to have you consider infinite banking for your family and what you're trying to do. So let me share my screen very quickly about kind of the our infinite banking success roadmap and what this looks like. So most importantly, what we're trying to do is define a financial roadmap implementing this infinite banking strategy, which is a life insurance policy designed and structured for cash value. So what this looks like, which you're already past all this, which was signing and approving your HIPAA authorization form and getting into underwriting, which as you already know, this does not bind you. This does not cost you. And also it doesn't even bind the insurance company anything, but this is a necessary step in order to actually receive a health rating from the insurance company. So again, if you haven't already, please click this link and watch the video series, which is about 22 minutes long. It goes into, again, the hows and the whys of this strategy working maybe for you and your family. The next steps after this, of course, is getting on a customization call with Mackinley, who you've already spoken with on the phone. We're going to go over just, again, your situation, what you're trying to accomplish, and how and if this strategy even fits into your portfolio of what you're trying to do. Then we'll get what we call our next step questionnaire, which is pulled up right here. Again, Mackinley has either sent this or is going to send this to you. And Mackinley, I'd like you to kind of go into this a little bit of like what exactly we're looking for here on just our next step questionnaires to help somebody, achieve what they're trying to achieve.
Yeah, for sure. So this form really just helps us get a good idea of, what are our current inflows and outflows flows per month? What can we strategize and take down with the policy? Like we want to give you some tangible steps on how we can utilize this strategy and like implement it, take some action in your life. So as you'll see, this is kind of monthly outflows and inflows. We want to know purchases on the horizon. This is any four-figure purchase, right? Anything from cars to engagement rings to kids' braces, college funds, you name it, go ahead and put it down on the sheet because we want to strategize of, hey, how can we use these dollars, let it be working in the policy, and deploy it out and use it in your life. So that's
Yeah.
kind of a
Yeah,
good start.
the point of this again, guys, is to again purchase debts, own assets, and recapture outgoing interest. That's really the goal here. So
Right.
after we dissect that next step questionnaire, again we'll get that health rating approval. We'll place the policy in force, and we'll execute our action plan, and then kind of go after we're approved and after we're under, we placed our policy in force. We'll actually get through talking about your spouse and your children, protecting business equity if that's your situation. But that's a little bit down the line. What I like to focus on next is just the customization call, which is again specific to what you are trying to accomplish. So let me just break this down very briefly of what an infinite banking policy can do for you. And again, you need to ask yourself if this is interesting or could benefit you in your own life. So the way that we build these policies, there's a couple of main headline metrics and ratios and things that are important in these policies. Now, these sound a little cliche, but it's reality, right? You have to ask yourself these questions. So over these next 8 questions or however many there are, I'd like you to answer them, to yourself. For every deposit that you put in, would you want half of it or the entire amount to be? Actually, let's do a little mock trial, Mackinley. You
Yeah,
and I, let's do this as a joke.
sure.
Every deposit, would you like creditor and litigation protection of your entire deposit?
Of course. Yeah. I know that's important for people in real estate, business owners, individuals, because if you're getting sued, the first thing they're coming for is your liquid assets, right? Your savings account, your checking account, you name it, right?
That's right. That's right. No, 100%. And again, this is a little it's a little mock trial kind of thing, but again, you can follow along with this. Do
Sure.
you want the IRS maximum liquidity of each deposit, meaning for as much of money that you legally can put into this thing, you can have liquidity and access to?
Of course, maximum liquidity.
Global flexibility of deposit, meaning whatever amount that you decide, whether it's $1 million or whether it's $1,000, do you want to have flexibility by the month, by annually, a hybrid of both on how you can deposit that money into your policy?
For sure.
Okay.
Funding options.
Yeah.
Yep.
Just flexibility on deposit.
Yep.
Do you want a competitive guaranteed annual policy growth that's outside of market volatility. I
For
mean,
sure, for sure.
it's
These are we got our savings dollars and investing. These are my savings dollars earmarked for purchases. I want growth. I want safety for sure.
This is a funny one. Tax-free opposed to tax deferred or tax annually. If you guys are studying the market right now, we're going into debt another $1 trillion every 100 days, and this is April 1st of 2025. So it's probably getting higher from there. So you have to ask yourself, do you want to defer tax or not pay taxes in the future or pay it annually? Do you prefer taxes never or taxes in the future? What do you think?
Taxes never. Don't want Uncle Sam to be a player in my game for sure.
Two more. Do you want, now again, these are just cliche, but do you want complete decision-making privacy? Meaning when you decide to take a policy loan, changing a beneficiary, if that's the case, you're transferring ownership to somebody else. Do you want to alert the press or put it in the Kokomo Tribune of what you're doing with your money? Or would you
No.
prefer it to be completely private?
Private, private.
All right. And then finally, ease of transferability and managing without fees or penalty. That's kind of the main key here. And all the rest of the accounts that are out in the marketplace, you're paying annual fees, whether it's 100 basis points, 150 basis points. Would you prefer to have easy transferability and zero maintenance or any types of fees or penalties?
Yes.
Okay, understood. Okay, guys, look, that's a very simple exercise, but it's very obvious that with whole life insurance, if it's designed properly, you get all of these. Every single one of these checks these boxes, and we can go moving forward on that. But most importantly, again, this next step questionnaire is what would lead this customization call going in, because again, what we're trying to do is again purchase assets, number one. But the easier way of doing this that not a lot of people think about is if you are able to purchase a debt. Like for example, let me give you an example of something that I've done in my own life. Most people don't consider this, but what I did, I actually had a vehicle. I still drive it. It's my Chevy Tahoe. I bought this vehicle back at the end of 2022, and we had a trade in. It was a $55,000 total amount of money that we would owe to Donahue Auto, and over in Pelham, Alabama. And what I did is I went to them. They offered us a $55,000 truck. I went to America First Credit Union and asked them what they would charge me in interest over the next 72 months, and they said we charge you 5.25 in interest rate, and whatever that payment would be amortized. So I had two options at this point. I could borrow the money from American First Credit Union, or I could use just money from my bank account and just pay the car off. But the third window that I decided to use instead, though, was I went to my insurance company, the Emeritus Life, and I took a loan from my policy. And what I did is I took a $55,000 policy loan and I wrote a check to Donahue Auto. And what I did though, instead of just letting it ride, is I charged myself every single month. This is a promissory note to myself from my business to myself. I even signed it, which is a little silly. But every month, what I actually do is I pay myself $896 every single month, which is number one most important. That's principal and interest that the bank would have earned. I own the vehicle, so I'm not going to end up on True TV and the Repo Boys. But third most important piece is I'm in control of the cash flow. Nobody's coming to get me and tell me what to do if I don't pay a monthly payment back. But most importantly, every single month that I refill my account, every dollar of 896 is immediately liquid, but I'm also earning the interest that the bank would have otherwise earned. McKinley, do you have a thought on that?
Right. And you're in control, but you also just made what was a monthly outflow to America's First is now an inflow into, back into your policy to refill that bucket. So, you're in control, but you also just made an outflow and inflow, which I think is important.
Yes, 100%.
And
So
then obviously number four, right there over the next 72 months. Like that's what blew my mind. Yeah.
yeah. Yeah, and that's another piece that sometimes most people don't consider is this 9,200 bucks, which doesn't sound like a really large number. That's the interest that the bank would have otherwise earned off of me, but instead I'm the one that's earning that interest. And then on top of it, too, I mean, if you really want to get philosophical, imagine if this number was $550,000. Then this number would have had an extra zero on it. It'd been $92,000 in interest that I would have earned. And my life didn't change. I was still going to have to refill that account somewhere, anywhere, right? It's pretty much the same anyway. So that's a great point that the fact is you're earning interest that somebody else would have earned while being in complete control.
Right.
Okay.
And your dollar's still growing in the background because of
Yeah, your
leverage.
policy's still doing its thing, even if you were in there, you weren't in there. So
Exactly.
what this policy looks like, let me just give you a quick hypothetical or what this looks like. Let's just use Johnny Appleseed for an example. And this is exactly what it would look like for you. We'd put your name in here like this. How these policies are designed, because I don't know if I pulled up my oh here, eliminate taxes. But how these policies are designed are very simple. You've got two numbers working inside of every policy. I'm gonna use the example today of $25,000 because it's easy for everyone to notice and see. So, and again, I don't know what 10,000, I think it's 866, 867 a month, something like that, whatever it is, right? Whatever. Should have been more prepared. Either way. So $25,000, that's the number that we're using. If you put this amount of money into a life insurance policy, this number is split into two different numbers. $10,000 goes to base premium, and base premium is the cost of insurance. Now, this is just something that you cannot get around. It is the IRS's way of forcing us to play by their rules. It's just reality. If you want to have less base premium, well, then you're going to have to participate in qualified plans and around and dance with Uncle Sam and get a 1099 every year for the profits of the policy. That's just the reality of the world. So the extra cash here, though, this 15,000 or this FPUR, this is called flexible paid up rider. In this percentage of 60/40, no matter if you add a zero or take off a zero, this is going to be how your policy is constructed, regardless of age and health and size. It's just the IRS created this ratio, and there's just no other way to get around it. So, whatever that number looks like, the 15,000 is immediately available on deposit for liquidity to deploy out into a business, purchase a debt like we were just speaking about. This 10,000 of illiquidity in year one only has to be deposited, whether it's annually or monthly. McKinley, you got a thought on that?
Yeah, yeah, correct. Like you said, after year one, we've got to prepare for that illiquidity drag. And then after that, every dollar that you put into this thing, whether it's base premium or rider cash, right? It's immediately liquid. So it's like moving money from your left pocket to your right pocket. It's just that first year you take that. But anybody in real estate or business owner understands that there's startup costs for anything worth having. It's kind of like having, I like the next slide too, where it talks about equity within the home, or sorry, the next one down. Yeah. It's like, like you have equity in this asset that's your home. You've got your equity, your cash value within this asset that is your IBC policy, the death benefit. Right. I think that's a good little illustration there.
Yeah, at the end of the day, your whole life insurance policy is pretty close, identical to real estate, where, if you are every month you're making your mortgage payment in your home, you're building equity, which is AKA ownership. And every single month you have more ownership than you did the month before because you're growing in value or you're growing in equity. Whole life insurance is identical. By every month that you make a premium deposit, you have liquidity or more access of ownership to the death benefit, which is your asset, the same way that you're able to borrow against the asset of your home. That's kind of how those two ideas are identical in design. So
Mhm.
what a policy will look like, let me give you an example here. Like I said, this is what something would look like. And again, this is kind of silly, but it's Johnny Appleseed. You could be older, you could be younger. This will determine based upon your age and your health. But this is about the middle of the fairway. And look, there's a lot going on here regarding numbers and contract premium and riders and all this kind of stuff. I like to focus on these two highlighted columns: cash outlay and cash value. Cash outlay is your deposit, cash value is your liquidity. Okay. So, again, if you're only thinking about the next 12 to 24 months in your own life, then this probably is not going to be for you. It's not a short term play, it's a long term solution to somebody that needs capital. So, If you're thinking long range over the next 10 years, Johnny Appleseed is going to put $160,000 into this policy. His cash value is going to be 173,000 and some change. Now, I would go a step further and I would ask at this point here, Mackinley,
Sure.
how much did this $666,000 of death benefit, how much did that actually cost Johnny Appleseed at that point?
So the illiquidity drag in year one.
Well, I'm actually curious because you've got
Okay.
173,000 in cash value. You put in 160. What is the cost of this death benefit?
Time.
Time. That's it. You've got more money than you put into it. This becomes permanent death benefit that you cannot outlive. And you've got, again, more money than you put in. So, again, the only thing that it cost you was time to get to that, which is
Right.
like any other location of any way. Yeah.
Mm-hmm.
Is
That's
that
good.
what's your opinion of that?
Yeah, I think it's really good. And of course we illustrate this until year 10 and hypothetically we cut it off just so you can see that spread start to form. But in reality, you can continue to contribute that base, 10,000 for as long as you wanted to. We just want you to see kind of the growth in the background as time goes on, right? Because you'll see globally, if you didn't put another dollar in for another 10 years, kind of what your liquidity is on the other end, globally what you've put in versus the amount that you have available to go deploy and use. And then obviously you see that death benefit start to grow, which is not why we do it, right? We're not doing this for the death benefit. We're doing it for today's, banking function. The death benefit's just a cherry on top, right? It's tax free. It's going to get handed to your beneficiary one day. Great way to pass down wealth while using it as a working capital account along the way. And Nolan, I think another important thing to note is that annual dividend column, right? I mean, this is the profits that you get to take part in as an owner, right? They start out pretty small, but over time they get really significant. And I mean, we would recommend to funnel those back to the policy as cash.
Yeah, and on top of that too, the way that I think about it is the dividends and the policy is cool. And I say this to everybody, you will not, and this is my disclaimer here. This is what I think is the most important piece you can get out of this video. You're not going to get rich from this life insurance policy. You are not going to become a real estate mogul because you put money in a life insurance policy. But what will happen mathematically is if you use the insurance company's money to invest in real estate or invest in your business, you are mathematically going to come out on top. Let me give you an example here. First, this is just another policy design that I like to share with people that, again, just shows that kind of what different ways that you can fund your policy. Now, again, there's a couple different ways that you can fund this. The first option would be all at once. You can just write an ACH for 25,000, which is 10,000 towards your base premium and 15,000 towards your paid up addition. You can do your second option, which is depositing the base premium monthly, and then within the next 12 months you can deposit the paid up addition rider at any moment. And then the third option is doing the base monthly and the rider monthly. So you'd be basically ACHing $2,083 a month, and then a portion of this goes to liquidity. And then over the next 10 years, you can see this liquidity on deposit just grows and grows and grows every single year. So if you're looking at year 7, again, we're not playing the short term here, but you put $10,000 in year 6, the next on deposit you put 10,000 in, it goes from 113 to $128,000. So you basically had 150% improvement of liquidity on deposit, which there's just not a lot of locations where that kind of things happens. I mean, without taking any risk and without paying any taxes.
Mhm.
So just a thought there. This is just something that we can utilize again if you're playing the long game. But
Yeah.
I want to go ahead, McKinley. You have something?
Yeah, yeah. I'd say option one is pretty popular, right? Most people do option one because they like to kick off the compounding effect on a bigger number, not think about it for another 12 months. Option two is pretty popular too, kind of spreads out that illiquidity in year one, and then every single month after year one, it's liquid every single deposit. But really option one and two are probably the most popular, wouldn't you say, Nolan?
Yeah, I mean, again, every situation is unique. Everyone's different depending upon where they are. I just, again, that's one thing that we can get with you after, we watch this and we figure out exactly what you're wanting to do and accomplish after you fill out your next step questionnaire. That's going to allow us to, again, give you the best recommendation on your situation. So that's what we'd be. But let me give you an example, like I said a second ago, about how your life insurance policy will not make you rich, but if you use the insurance company's money to invest in businesses or real estate, how your cash flow and your cash on cash return just is enhanced. So check this out. This is something that we do with a lot of our clients actually. I'll spare you guys on this buy sell agreement that might be outside of the scope of this video. But just imagine that you had one life insurance policy in this little box here, okay? Most importantly, this is a tax-free, litigation-protected account. The money that's inside your life insurance policy cannot be touched by an attorney, and it cannot be touched by Uncle Sam, which what account out there really is not exposed to that at this point, right? What we recommend investors to do is they borrow from their life insurance policy and they put that money into their personal account, okay? That personal account, let's say you're looking to purchase a piece of property. You take, let's say it was 100,000 or if it was 20,000 or more or less, it doesn't matter. Let's just use 100,000 for the roundest numbers of all time. You take 100,000 and you go and invest that in your real estate business account, okay? And from that real estate business account, you go and deploy that into purchasing a piece of property, right? $1 million building or the grandma Patty's property down the street that you just bought someone's house, right? It doesn't matter, right? The point is you deployed capital into a piece of property. Now, if you're savvy or if you're not savvy, you're looking to create cash flow. That building is going to throw off rental income. That cash flow goes back into your business account, which is where the majority of the action happens. If you're a limited partner, again, that's a little bit beyond the scope of this, but you're going to get a distribution or you're going to get cash flow of anywhere from 8 to 12% on that money. And that money is going to flow back into your personal account. Now, let's say that you earn 12%, which is not uncommon in residential real estate or commercial real estate. It's actually very common. So let's say you earn 12%. That means that, think about it. Let's say you borrowed $100,000 from your policy and you just earned $12,000 in cash flow or $1,000 a month from your investment real estate. Now, what happens from that account is you repay your policy loan back into your life insurance policy, just like the way that you would put it back into your regular checking account. But the difference is that instead of you earning 12% on your money, instead, your money is still in this account, compounding, doing its thing, again, protected from taxes and litigation. The insurance company, all the while, is charging you 4%. And you're thinking, why would I pay 4% to use my own money? Well, you're not. You're using the insurance company's money. And that allows your money to be safe and sound and compounding over here. But the reason why this is so important is if you do the math. Now, Mackinley, you're a mathematician. I went to public school, so I'm not an expert here. But what is 12 divided by 4?
3.
3. You made 300% return on investment because you decided to use someone else's money versus your own. So think about it. If you would have not introduced infinite banking and you would have just been using these top 3 parcels right here, you would have just only used your personal account, you would have earned 12%. If you put 100 grand into something and earned $12,000, it's 12%. Again, not a bad day. Nobody's complaining about that. But if you're able to use the insurance company's money at 4%, where your money is still growing, you'll start earning on the 100,000 in your account, and all you're exposed to is 4 grand. You just increased your cash on cash return to 300%, and you didn't change anything in your life. So that's what, in my book, is where the hill that I'm willing to die on is cash on cash return. And when you see it, you can't unsee it. So again, whether you're into real estate, whether you're investing in your business, whether you're trying to buy a skid steer for your farming company, whatever it is, Using other people's money that you have control over and you control the amortization and the payback schedule, there is no better leverage that's out there than using whole life insurance to invest in your business and to create cash flow. Because if you use up someone else's money, you're most likely and almost guaranteed to have a higher cash on cash return. McKinley, do you have any final thoughts on that?
Yeah, I mean, seeing this, Nolan, you're actually the one who taught me about this, right? It's truly an infinite return. Like this is called infinite banking. This is the game. This is how it works.
So 1,000%. So end of the day of this, guys, everything is about how you want to utilize your policy. We're not going to tell you what to do. We're not going to tell you how much or how little to do. The key from this is we are going to request a health rating and a certain amount of policy that of dollars that we want to approve on. Once you respond back to us with that next step questionnaire, and we can actually start to develop an idea of what's going to be best and most beneficial to you, that's when we'll get on a call like this for 15, 20 minutes, dissect exactly the next steps. We can pull the trigger and then immediately start taking action with policy loans out in the marketplace, which is purchasing debts, purchasing assets, and redirecting cash flows back to us. But most importantly, recapturing interest that would otherwise gone to somebody else out in the marketplace. So any final thoughts, Mac, before we get out of here?
Yeah, whether, whatever we went over, it's examples, right? If it's double the size, half the size, it doesn't matter. It's just about getting started, taking some action. Your first policy is going to be the best just because your runway is the longest. So yeah, let's get started.
Awesome. Okay, well, that sounds great, guys. Get back with us, watch this video, and let us know when you get with us because we cannot wait to get started with you. Talk to you guys soon. Thanks so much.